Hi everybody, in this video we are going to cover chapters 1 and 2. Chapter 1 is about an overview of financial management. We are going to talk about forms of business organizations, how to create value for investors, stockholder, manager, debt holder conflicts, and balancing shareholder interest and society interests. Now, the role of the finance within the organization is pretty much the accounting, treasury, credit, legal, and capital budgeting and investor relationships. And everything else is pretty much captured under Chief Operating Officer, which is the person is responsible for running marketing, production, human resources, and other operating departments. The forms of business organization, there are three types: proprietorship, partnership, and corporation. In this course, throughout the course, we are going to cover and look at the form of business organization from corporation standpoint. Usually, this is in the order of number of people in the specific organization. Proprietorship is usually one single entity organization. Partnership is within several partners, and corporation is usually divided along many shareholders. Before we go into specifics of corporations, again, the rest of the course is pretty much run through from the perspective of corporation, but I want to talk briefly about the proprietorship and partnerships. The advantages are these types of forms of organizations are relatively easier to form. They are subject to fewer regulations. For example, corporations are subject to more regulations, and usually there are not what's called a double taxation, so there is no corporate income taxes. It's passed through, and the people who are responsible for the proprietorship or partnerships are responsible for the taxes on their income taxes, and there is no corporate income taxes. The disadvantages are it is difficult for these type of organizations to raise capital. Especially with the proprietorship, there is liability and there is limited life. So especially with the proprietorship, if the person passes away, usually the form of the organization died. On the other hand, on the corporation side, there is limited liability, and we are going to see that there is unlimited life regarding to the corporation itself. Again, the advantages of corporations are unlimited life. There's easy transfer of ownership. You can buy and sell common stock in the stock market. There is limited liability in the sense that corporations, if there is a liability, then the corporation, but not the shareholders, are liable. And corporations can raise capital in the debt markets through bonds, and in the stock market through IPOs or secondary offerings. They can raise capital relatively easier compared to proprietorships and partnerships. The disadvantages are double taxation, which is the corporation gets taxed. There is a tax on corporation. And then after tax profits, some of the profits gets distributed through dividends, and those dividends are subject to taxation again. So there is double taxation. And also corporations are subject to much stricter audits and reports and filing. So the cost of setup and filing of corporations is much harder compared to proprietorship or partnerships. So that's kind of another disadvantage. Throughout the course, what we are going to do is we are going to examine the stock price, and we are trying to find what is called the intrinsic value. There is always a price for a stock in the stock market. So when you look up Google Finance or Yahoo Finance, you are going to immediately find what the market prices a specific stock. Intrinsic value, on the other hand, what's called also the true value, is a long run concept. And the idea is to find the actual value of the particular company or a stock price, and then compare it to the current market value and see if it's a bargain, if it's a good buy opportunity, or if it's overpriced and hence needs to be sold. The stock's intrinsic value is can be captured as true cash flows and true risk. And what the stock market determines as stock price is perceived cash flows from investor standpoint and perceived risk. In market equilibrium, the intrinsic value should be equal to stock price. And what we are seeing is the stock price is deviating from intrinsic value, is fluctuating around the intrinsic value. Sometimes it goes up, so it's overpriced. Sometimes it goes down, so it's underpriced. But in the long term, the intrinsic value should be equal to stock price value. That's the fundamental of the course. We are trying to find the intrinsic value of the value of a specific stock, and then see how we compare it to the stock price itself. Now, when it comes to corporations, remember we are going to talk about the main topic of this particular course in general is corporations. And when we talk about corporations, there are stockholders and there are managers running the corporation. So, and sometimes there are conflicts between the stockholders and the managers, and the idea of incentive systems is to minimize the conflict between stockholders and the managers. Managers are inclined to act in their own best interests, and that may not always be the same interest of stockholders. The idea is to bring stockholder interest in line with the manager interest. And the factors explained in this is affects managerial behavior, which is managerial compensation packages. The compensation packages are usually designed to make sure that they have long-term interest. So the manager's long-term interest is aligned with the stockholders' long-term interest. And direct intervention by stockholders is another factor that affects managerial behavior. The threat of firing of managers is also an important factor, and the threat of takeover, which we are going to cover later in the course, in the chapters after the midterm. The threat of takeover is also another factor that is determining the manager interest. The stockholder versus debt holder conflicts. The stockholders are more likely to prefer riskier projects because there is more upside for them. Bondholders, on the other hand, receive a fixed payments, and they want to limit the risk of the actions that the company is specifically taking. Bondholders are particularly concerned about additional debt because their first priority is get their fixed payment and at the same time get their principal or the initial capital. Bondholders also attempt to protect themselves by having covenants in bond agreements that we are going to see when we are going to cover the bonds. And they limit the use of additional debt and constrain managers' actions from that perspective. The final piece I want to talk about the, chapter 1 is balancing shareholder interest and society interest, which is becoming more and more important from environmental issues perspective to all the way to financial regulations and how corporations can impact the overall health of the specific economy. And the primary goal of management is shareholder wealth maximization, and that translates into maximizing the stock price. And sometimes there is conflict between maximizing the stock price and having the social responsibility that may not be considered with maximizing shareholder value. And from that perspective, there are regulations in place, both from governmental perspective as well as mandates within the company that is trying to bring in line the shareholder interest and society interests. This pretty much captures everything I want to talk about chapter 1, and let's continue with chapter 2 for this first lecture. Okay, in chapter 2 we are going to cover financial markets and institutions. Specifically, we are going to look at capital allocation processes, financial markets, institutions, the stock markets and returns, and stock market efficiency. The main idea is to transfer capital between savers and borrowers. And this can be done primarily in 3 ways: through direct transfers, through investment banks, and through financial intermediaries. In a well-functioning economy, the idea is that the capital is flowing efficiently from those savers who supply the capital to those who demand it, usually the firms. Suppliers of the capital, again, are individuals or institutions with excess funds. They are savers. Demanders of the capital is the individuals or institutions who need to raise funds to finance the investment opportunities. And the key idea here is that these groups are willing to pay a rate of return on the capital that they borrow. We are going to talk about the rate of return in detail when we talk about debt and the stock. But before that, let's cover what a market is. When we talk about markets, specifically in finance sense, people usually think about the stock market. A market, in general, is a venue where goods and services are exchanged. And there is a specific piece of markets, a section of markets. It's a financial market. Is a place where individuals and organizations exchange funds from each other, and through different means. It's either through debts or through stocks. The types of financial markets, there are physical assets versus financial assets. For example, if you are in futures market for specifically oil or corn and any other commodity, and you are willing to take pay the price to get the actual physical asset, then we are talking about the physical assets market. Financial assets is usually the ones with stocks or with bonds, where you exchange those and then make sure that the funds flow from debtors, from savers to investors. There's a spot market versus futures market. Spot market is the exchange of financial or physical assets with the current price. Futures market, on the other hand, is basically exchanging an asset, whether it's physical or financial, in the future with a specific price predetermined at the point of sale. There are primary versus secondary markets. Primary markets are IPO markets or initial debt offering markets. And there are public versus private markets, where public markets are usually the stock exchanges that are open to pretty much everybody, all public. Private is more done what's called over the counter Two firms engage in exchanging funds, for example, if it's a debt transaction or if it's a stock transaction, and it's done usually again over the counter with two or more firms. It is important that financial markets are functioning very well, and they facilitate the flow of capital from investors to users of the capital. And it's been well provided with economic background that well-functioning financial markets promote economic growth. And this has been shown with where economies of well-developed markets perform better than economies with poorly functioning markets. We are going to dedicate one chapter and 1 week later after the midterm on derivatives, but let's talk about derivatives specifically, give you an overview of what derivatives are. Derivatives securities value is derived, as the name implies, from the price of another security. That security can be a stock, it can be a physical asset, for example, oil or corn or any other commodity. And options and futures are good example for these types of derivatives. Usually, the main use of derivatives is to hedge or reduce risk. For example, an importer whose profit falls when the dollar loses value could purchase currency futures that do well when the dollar weakens. So that's kind of like the hedge that the importer is taking. On the other hand, for example, if I am a farmer and if I'm producing corn, I can hedge the price of corn by basically going into futures market and fixing the price of the corn so that I'm hedged against a future downfall on the price of the corn, just as an example. And again, we are going to cover these in detail when we talk about derivatives later after the midterm. Derivatives are also used by speculators. It has been used for speculative purposes. And hence, what we've seen, especially in 2008, is derivatives can increase the risk or systemic risk a lot. So that's the downside of the derivatives, where governments throughout the world are trying to increase the regulations on these types of transactions. There are different types of financial institutions. Let's cover them briefly. There are investment banks and commercial banks, and we are going to cover mainly investment banks, what they do, how they value a corporation, how they value a specific bond. But there are other firms, again, financial services corporations, credit unions, pension funds are some of the examples. And for all these financial institutions, we are going to learn in this course the basic idea of how to value a specific asset. It can be either the stock or the firm itself. And we will see how that will translate into the financials of the different financial institutions. When we talk about markets, there are physical location exchange markets like New York Stock Exchange versus electronic dealer-based markets like NASDAQ. The differences of these markets are narrowing, so we don't see that much of a difference whether the stock is listed on New York Stock Exchange versus NASDAQ. Now, later in the chapter, we are going to see the stock market transactions. For example, if Apple decides to issue additional stock, whether they are going to issue it in the primary market or the secondary market. And we see that this is a primary market transaction. And if instead a buyer buys existing shares of Apple stock in the open market, then it's a secondary market transaction. Let's cover the topic of IPO as well. Initial public offering, IPO, occurs when the company issues the stock in public for the first time. Going public enables a company to raise more capital from a wide variety of different outside investors. Usually before IPO, companies raise capital from venture capital firms or other private investments. But once the company goes public, then the company can raise additional capital through the markets. But by that time, when the company goes public, these companies are subject to additional regulations and reporting requirements. And the reason for that is to cover the individual investors. We have learned the hard way in different crises that the individual investors need to be protected, and that's part of the reason why there are regulations and reporting requirements. I also want to show you the total returns of S&P 500 index. That's one of the indices that determine the value of the stock market. And as we can see, usually it's up with severe downturns in specific years. 2008 was one of them. 2001, 2002 is another one, and so on. So it's kind of cyclical in that sense. In order to find the stock code, usually it depends on the source, but I usually go to Yahoo Finance. I'm just used to it. It's been around for a very long time, and that's where you can find the latest quotes, and you can find different financials, the accounting information, etc. on Yahoo Finance. Now, let's talk about the stock market efficiency for a second. Securities are normally in equilibrium and are fairly priced is the idea. When large companies like Apple, Google, General Electric, and so on are followed by many analysts, and there is a good communication with investors, then the market is pretty much highly efficient. Everybody has pretty much all the information, and the prices adjust accordingly. So that market is thought to be highly efficient. Inefficient markets, it's a spectrum, and inefficient markets are usually where the companies are not followed by too many analysts, and there isn't much contact with the investors, so there isn't good information flowing through. So those markets are thought to be highly inefficient, just because there is a lack of efficiency in information flow. And there are again reasons why markets may not be efficient. And there is another branch of finance, behavioral finance, that is becoming more and more popular as we understand the insights from psychological perspective, why some of the investors behave irrationally and how they take risk in up markets and down markets, how overconfidence can lead to different biases, etc. So there are different reasons for inefficient markets, information flow being one of them, and the topic of behavioral finance, which is not part of this class, but it's an interesting part of finance, examines the inefficiency of markets. So in summary, in chapters 1 and 2, it's pretty much an introduction, and what I want to show you is what we are kind of going to cover in this course. Next week we are going to cover chapters 3 and 4, and for accounting majors it's going to be fairly fast because you pretty much know all the accounting concepts. And in session 3, in week 3, we are going to start covering fundamentals of finance, with starting time value of money operations.